the seminar. Thanks so much for attending. Today, we're really taking the international side of trusts and investments. We today have with us Nick and Sabina, who will present from UBP Investment Advisors. We basically exclusively recommend them to clients who are involved with international trusts and investment. We do so much international work that we need a resource like that in Switzerland. And what we're going to do is divide it up into two parts. We're going to take the first half on the foreign trust tax compliance, and UBP is going to take the second half on diversification from the US dollar. So I'm going to click on removing us from the screen so you can see the slides, and we'll get started. So we'll hit the PowerPoint, and that's the beginning of the PowerPoint. And the agenda is fairly straightforward. This is an agenda we actually could speak upon for quite some time. We have compressed it somewhat to take up only a half an hour, so you get a pretty nice overview, like the high points pretty much. If you have any questions at the end of the seminar, we'll have all our contact information, and also we'll have a question and answer short period at the end of the seminar. And also Tony will take any questions on the raise your hand. There's a little hand sign in the presentation. You can click and type in any questions you like. So feel free to interrupt us. We'll hit an overview of U.S. wealth transfer taxes. That's the estate and gift tax. We'll kind of describe the differences between the U.S. income tax and the U.S. transfer tax. So it's income versus estate. Very different rules, very different applications, and the crossover with the foreign trusts. So the foreign trusts implicate both the income and the estate and trust rules. And then we'll talk about compliance, what people need to file in terms of complying with their U.S. trust, either if they're form one or the beneficiary of one or their trustee. And then we'll conclude and we'll hand it over to Nick and Sabina to talk about diversification from the U.S. dollar. I'm going to let Brian speak for a while, who's a guru on estate tax. Go ahead, Brian.
Sure. This is sort of like as Gary had said, the Cliff Notes version, the high points. There's a lot of stuff here, so I'm going to be speaking with a broad brush just to give you some foundational background to understand the tax regime in the United States as relates to both wealth and transfer taxes, which is the estate and gift, and income taxes, and how the rules are different, but it's important to understand how they work. So when you utilize a foreign investment vehicle, that you can see what the consequences are both on the estate and the income side. So just as a broad view, in the United States, we have transfer taxes. And what that means is that for the privilege of transferring wealth, be it by gift or at death, through inheritance, our awesome government has a tax on it, that for that privilege. And there's basically three at the federal level and then one perhaps at the state level. Here in our home state of Florida, we do not have a state inheritance tax. Other U.S. states do. So that's just to give you an idea, and you would have to know your local area to decide. Hopefully you're in a jurisdiction where that's not the case. But at the federal side, there are three main ones. There's the estate tax, which is the one that we like to say the death tax. When you die, anything that is includable in your gross estate, all of your interest, all those things, it's valued. And if it exceeds in a certain amount, then you pay a tax. We have what's called the unified credit, which for 2021 under current law is $11.7 million per individual. And if you exceed that, then there's a 40% tax on that wealth.
We have a different presentation, and we have a copy of it if you'd like. And that's how that unified credit, that 11.7 million, which you basically you can die with that much and not be taxed. How that may change in the current administration. It's a different program, but it's good to know. And if you have any questions on how to reach that program or how to take a look at it, just let us know and we can send you a copy of that program, because we think we might have some pretty radical changes in the application of that estate and gift tax.
Yes, it's very likely that with the governmental control change in the United States that will change.
Very, very likely.
Very, very likely. The gift tax is a tax that if you make a transfer during your lifetime or inter vivos, that they also impose this tax. They're the same amounts. You know, in the old days it wasn't the case, but right now it's unified. So it means that if you give it by gift or when you die by inheritance, the tax is the same and the credit is the same. And it would just be the fair market value of the transfer at the time that you make it. So if I give a gift to Gary and it's $1,000, it's $1,000 of value that I've transferred, I'd have to report that on a Form 709, which is a gift tax return. Now you apply your credit, and if you're underneath the 11.7 million for your lifetime, no taxes.
You also get, it'd have to be 16,000, because under
oh yeah, that's true.
You got a $15,000 break, the famous 15.
That's right, the annual exclusion.
I'm waiting on that gift though.
Yeah, he's still waiting. Yes.
Yeah. Hopefully that occurs, and I'll help with the filing if necessary. Hasn't happened yet.
Yeah. So yeah, I mean that's something that's not really here, but yes, every individual in the United States that as a U.S. resident gets a $15,000 annual amount that they can give to anybody, anywhere, and it's excluded from tax. So that's not there, but that's just called the annual exclusion amount. Those are the two main taxes that affect most individuals. The generation skipping transfer tax, or GST tax for short, that is the idea that people in Congress in the United States felt it was unfair that if you're extremely wealthy, you could bypass your kids and give gifts directly to your grandkids or great grandkids. And they thought that that was unfair because you would only pay the gift or estate tax once. So they imposed this other tax that says that if you skip a generation, they impose another tax, as if you went through the estate tax twice. That's how it operates. The credit amount is the same. So you get 11.7 million in 2021 under current law, but it's very common if you give, if you have a trust for the grandkids, or you give a gift to a grandkid, or if they're unrelated, anyone that is 37.5 years younger than you, it applies. So that's the broad overview of wealth and estate taxes. They're there. It's important to understand, and depending on the vehicle that's used for a foreign trust, they may or may not apply. Now, that's the estate and gift side. That's in subtitle B of the Internal Revenue Code in the United States. Under subtitle A is the income taxes. And this is where, from the perspective of compliance, as an ongoing basis, these rules are very important because it will affect your foreign vehicle each year. Potentially when you create it, and or when you die or you no longer have a U.S. beneficiary.
And it's also one of the few areas where the way you're treated for income tax purposes will impact the estate and gift tax application upon the death of the grantor.
That's right. That's right. So under subtitle J of the Internal Revenue Code, that's where you find these rules if you're interested. But basically, it gives you basic definitions of things such as a simple and complex trust, what is a foreign or domestic trust. There are rules if you accumulate income in a trust and you do not distribute it out in the year that it's earned by the trust, that there's an additional tax on it when it's distributed to a beneficiary. It's called the throwback rules or accumulation tax. And then lastly, there are some rules that were imposed in the 50s trying to prevent arbitrage by very wealthy individuals, called the granted trust rules. You create an irrevocable trust for somebody, but you continue to be taxed for income taxes for the person who made the trust, the creator. They're still taxed.
And it's created a lot of planning opportunities.
That's right. So trying to eliminate one issue, they created a bunch of planning opportunities for us.
Quite a bit.
Okay, as a basic rule, trusts are distinct income tax paying entities under U.S. law, federal law. So if you have a trust that's not a grantor trust, which means that it's taxed to the individual that actually created it or the settlor, then it will file its own income tax return every year. That's a Form 1041. The same rules apply to relates to income. Depending on the rules of the trust, if it requires it to distribute all the annual income in a year to the beneficiaries, it's taxed one way. And if you can accumulate and sprinkle the income over time, it's a complex trust and it's taxed differently, and it has a tiered distribution system for taxes. This is a lot of stuff just to give you basic rules of how it works, but generally if a trust has income and it pushes it out to a beneficiary in a given year with a K-1, the beneficiary pays the income tax.
That's right.
That's the basic rule. And when it comes to taxes, if it's a simple trust, these rules are satisfied by the terms of the trust. It requires all the income distributed in a year. You can't make any terrible distributions, and you can't distribute the corpus, the principal. If the trust follows those three rules and it qualifies, it's a simple trust, and each year that trust will only file a informational return because the entity itself doesn't pay the tax. The
It's a very basic way to set things up. It sends all of its income out every year, and it doesn't really manipulate or distribute corpus. It's super simple. It's uncommon, but there are certain kinds of trusts we do set up a simple trust. More common is a complex.
And if it's a simple trust, it's merely a conduit. That's all it is.
Conduit, right.
Now, if you have a complex trust, it just means that it fails one or all of those requirements above. And that affects it because at that point, the trust itself may or may not have an income tax return each year. And it's important because under U.S. tax, income tax law, trusts are at a very low tax bracket in that they meet the marginal rate at $13,000.
Well, they're taxed at the highest rate at the 13,000. So you have to be careful leaving income in trusts.
They have some rules. They each get a deduction amount for the return. It's very, very small because this was written back in the 1950s. Hasn't changed, but basically zero. But it's important that you must classify your trust to understand how it's taxed and how it will affect the beneficiaries each year. These are just some basic things here. We've already gone over the rules and where it's taxed, but basically you can't distribute principal. That's the main issue when it comes to that. And the beneficiaries really pay the tax. Complex are a little different. That's why they're called a complex trust. It depends on the terms of the trust. Generally, these are trusts that give the trustee discretion to distribute income, especially if they're protective for the beneficiaries. And depending on the type of income earned, how old it is, and its character, it will affect how it's taxed and how it's pushed out to the beneficiary. Generally, capital gains are taxed at the trust level. Income is pushed out. That's ordinary. And then if you do accumulate income in a given tax year, in the following year, the trustee distributes the income in excess of the income earned in the following year, you have an accumulation tax. Okay, those are the basic income and estate tax rules, and those are important to understand how it affects using foreign vehicles for planning. Now, if you're a U.S. resident person, all your worldwide income is taxable, no matter where it is.
Yeah, I mean, we're a worldwide income taxation jurisdiction. So we have, like for instance, today we had a call. We have a number of clients that aren't from the U.S. and they're only taxed by their country on income that they earn in their country. So we have one, for instance, that's leaving their country and they won't have any income from their country and they won't be taxed by their country, which is interesting. That's not the case in the US. What's interesting about the US is we have a worldwide income format for income tax. We also have a worldwide estate tax format for citizens and residents, but the definition of resident, making them worldwide, subject to worldwide taxation, is completely different for income and estate tax.
Right. The rules are different. That's
Yeah.
right. For the income tax, the most common ones are either you're a citizen or a permanent resident. You have a green card, or you have a visa and you live here, or you meet the substantial presence test, which is in a given year you're in the United States over an amount of days that exceeds 183 for the given year, and then if you go back 3 years, it's a running average.
It's a weighted
average.
It's a weighted, so it's less weighty for years, 2 years, 1 year back and 2 years back. Then they basically divide it by 6 and give you 3, 1/2 of those of the weight for the current year, where you're here half the year. But that's only income. So that comes into play, for instance, if you have someone's here too many days and they have a lot of income abroad. So someone, they're foreign, they're from Brazil, or they're from, it really doesn't matter unless there's a non-treaty country, and they're here too many days and they hit the substantial presence test, and all of a sudden the US taxes all their income in Brazil. And that's why you have people who rely on what's called the cocktail party rule. The cocktail party rule means that, so this is what people live on, these people with $200 million. They live on the cocktail, and that basically means that if you're not here 120 days, right, then the average cannot ever slip over the number of days that puts you in the substantial presence test. So we have a lot of people living on a cocktail party rule because all their income otherwise in their home country will be taxed by the IRS. And then that creates its own issues, a lot of which you can get around. But the estate tax is a totally different intentions-based standard. Go ahead.
With the estate tax, the rules are different. Mainly, the test is, do you reside there and do you intend to stay? So it's domicile, so physical presence and intent to remain. So it's possible for you to be an income tax resident for U.S. tax purposes, but not for a state. You can also be one for a state, but not for income. So it's important to understand the rules because the rules are different and the outcomes can be drastically different.
And a lot of people think, everyone, when you have an audit, an estate tax audit, that the person, the individual who was here a number of days and they may be income tax residents, that the answer is always, oh, no, I didn't intend to stay.
That's right.
No, I was leaving. I was going back home. But that's not always the case. That's not always. You have to be careful with that, because sometimes even an individual not a citizen of the United States has a lot of U.S. assets. And what happens is, as we'll talk about for a minute here in a second, you may want that credit. You might want that $11.7 million credit to cover those U.S. assets. Whereas you may not want to, in that case, you may not want to say, no, I actually did intend to stay.
Well, it's different because if you're a non-resident, non-citizen, your credit amount is $60,000.
That's why.
As opposed to 11.7 million.
No, he intended to stay.
He intended to stay. That's right. He wanted to stay for sure.
Yeah. That, by the way, that only occurs from a lack of planning.
Right. But these rules also give, if you're a green card holder in the United States, a way to plan potentially for estate taxes. You can domicile someplace else. We have a lot of non-U.S. assets.
Oh, absolutely.
But so that's something that can be planned around. If you're a non-U.S. person, you're subject to usually it's source income in the United States with some exceptions. The main one is the sale of stock. At least right now. That might change with the new administration, but right now
that would be a big change. That's a very old rule. But yeah, a lot of individuals don't realize the U.S. individuals don't. The foreign people know that you can buy and sell securities in the U.S. And no capital gains.
Yeah, it's amazing.
So that's why you have a lot of foreign investments in U.S. securities. Now that was true for real estate until I think 82 or something like that. And you can no longer do that with real estate. If you buy and sell real estate in the U.S., it's taxed under a different regime. It's like a capital gains.
We have treaties with certain countries, and that's just a fact-intensive thing. If you have passive income and you're a non-citizen, non-resident, there's a 30% withholding
right
of that,
and no deductions unless you make a certain election.
That's right. And then if you're connected to a business of some sort, then they're graduated rates for it's called effectively connected to income. And then lastly, if you're a foreign trust, there's not really any unless it's ECI or it's real estate gains.
Well, if you're a foreign trust, you're an independent entity.
Right.
So it's just like you having source. You have to have U.S. source income to be taxed, right?
Right. And then U.S. beneficiaries of a foreign trust will not have an income until it's actually distributed to them. For a state, non-resident, non-citizens are not subject to the U.S. estate tax on their worldwide assets, only on U.S. situs assets that they own individually.
Yeah. So what we do is when we have a chance to plan, you can almost always plan around the estate tax for non-citizen, non-resident by creating an offshore entity, and that entity offshore would own the U.S. property, or an entity in the U.S. to own the U.S. property. The entity offshore doesn't die, and it's an exemption. It's a exception from U.S. estate tax. So if you have an individual who purchases any U.S. source asset, you have to be very careful, because if the individual dies, there's very little. It's only $60,000 state tax credit. You have to avoid that issue, and it's avoidable by creating an offshore entity. If that individual dies, we had a terrible situation about a year and a half ago, where a husband and wife bought a mansion in the middle of Florida, and mom died, and they hadn't bought it in a foreign entity, so there was an $800,000 tax. The death tax that was due immediately. There's no husband and wife exemption or anything. And that tax could have been completely avoided.
Yeah. One of the big exceptions, if you're a non-resident, non-citizen, is the gift of intangibles. That you're able to make gifts, and there's no U.S. estate or gift tax on that transfer. And then obviously, depending on the jurisdiction, there may be a treaty with the United States. That's just a factual thing.
But if you die with the intangible and you don't give it away, right, you're taxed.
You're taxed, yeah. And with a $60,000 credit. Okay, so now we have the basic rules. And how does this relate to international taxation of trust? Well, if you're a U.S. individual, U.S. resident, and you create a foreign trust, these tax regimes affect you. The question is how, and it's important, especially on the income tax side, because the idea is that if you create a foreign entity, a foreign trust, and you put assets inside that trust and it's offshore, it's basically like an expatriation. Those assets have left the United States tax base.
Well, there's a regime for a tax that occurs upon expatriation, individual moving and giving up U.S. citizenship, and there's a corresponding tax for moving assets, U.S. assets, into a foreign trust. We'll get into a couple of those pieces, and then we'll actually talk about compliance for a couple minutes, and then we'll.
Yeah, it's just a lot of stuff. Yeah, we're running out of time here. But basically, when you have one of these, the income tax ramifications affect both the individuals who actually form the trust, who create the trust and fund the trust, the settlors, the trustees of the trust themselves, the requirements they have to make filings, and then the beneficiaries in the U.S. They also have, it affects them as well, depending on how they receive distributions from the foreign trust, and all these reporting obligations that are imposed on these parties. And then depending on when the foreign trust is created, there may be an income tax. When is it created? For sure, when income is likely distributed out, and then if it is a grantor trust for federal income taxes, when the person dies or there's no longer a U.S. beneficiary, there is an income realization event under the code. So it just depends. Non-resident aliens have unique rules, and basically a foreign trust, once it's created and it's outside the United States, it basically is treated like a non-resident alien for income tax.
And it allows us to move assets out of the U.S. tax net if someone's going to come in, because later they can come in, we can actually make it into a domestic trust.
That's right.
And there is no it's still, you still avoid the estate tax.
That's right. It's a great planning tool before individuals come to the United States if they're willing to plan. And you take time, do it right. No one ever wants to wait about times we see. Okay. So what's a foreign trust? Well, if you have a trust that fails one or both of these tests, it's considered a foreign trust for U.S. income taxes. The court test: does a U.S. court have the authority to bind trust operations? And then you have the control test: where's the trustee? So if you have both are here domestically in the United States, then it's a domestic trust.
If not, it's a foreign trust. We're going to go into those reporting obligations.
Right. And it's important because if you have a U.S. grantor of a foreign trust, generally on the transfer of assets to the foreign trust, it's a deemed sale of those assets.
But if you have a U.S. beneficiary.
But if you have a U.S. beneficiary, it's considered a grantor trust during the grantor's lifetime, so there's no income tax due until they die. And then all the appreciation, everything, as if there's a deemed sale at that time, unless it was an incomplete gift and those assets are pulled back into the grantor's gross estate for federal estate taxes. So like we said before, it's like the expatriation tax that you have if you just left with the asset individually. So it's just some things here but it's very important, because even if you have a domestic trust and the trustee dies or resigns, and you have a family member or individual in a foreign country outside the United States that becomes the trustee, guess what? You just transformed your domestic trust into a foreign one.
And here's what you have to file.
Right. That's right. So you have a foreign trust. This is from the compliance side. Form 3520 is probably the most important one you need to be aware of. Individuals who give stuff to a foreign trust, those who are deemed the owner, and those that are U.S. beneficiaries of a foreign trust will have to, file this form each year with their income tax return. And it's a big form, so only certain parts will apply, but it's annual. It's every year. So if you're a donor, you make gifts, Part 1 applies. You'll fill that out each year, and you have to file it. If you're treated as the U.S. owner of a foreign trust, you fill out Part 2. Annually, it has to be filed, and if you don't, there are some serious penalties behind that. And it's always filed with the taxpayer's individual tax return, which is April the 15th, including extensions. And then if you're a U.S. beneficiary, you also have to file this even when you don't receive a distribution in a given year.
It's a matching format where the IRS wants to know from everybody what happened, just so they can find some kind of discrepancy.
That's right. It's all informational, but yes, it's very important. You attach it to your return so they're able to see it. Now, this is also important as well if you're a U.S. individual and you receive a gift from a foreign source. this also applies. So even if it's not from a foreign trust, it's from something else. If it exceeds $100,000 from an individual or an estate, you have to file this form. If it's from an entity offshore, it's for 2021, it's only $16,815. So you have to file it every year. And as Gary explained, it's for matching. They want to see where this income, where the sources are from. Now, from the foreign trust side, if you have a foreign trustee, every year they have to file with the IRS a Form 3520A. And it's due March the 15th of each, so the following year. So for 2020, this form would be due March the 15th, 2021. Now, what's in this form? Well, one is just basic tax information. They want to be able to see all the income from foreign sources and where is it coming from. And then they also want a balance sheet each year. So they can see what's inside.
So you have to be careful. If you appoint your uncle in Holland as trustee one year, you slip into a foreign trust status even though nothing else happened, and you have to do all of this reporting.
It's a lot of reporting. Yeah. They also have two forms that are given to the U.S. taxpayers. One is the foreign grant or trust owner statement that has to be filed with the owner of the foreign trust, his individual tax return with his 3520. There's also one for every beneficiary. That's sort of like the K-1. They can see where the income is coming from and where it is. These are all due from the foreign trustee on March the 15th. If the foreign trustee fails to do it, the U.S. owner is responsible, penalty-wise. There are some other compliance things you need to be aware of. The FATCA rules. If you reside in the United States and you're unmarried, if you have more than $50,000 from a foreign source, foreign place, foreign account, you have to file this form each year. If you're married, it's over $100,000.
And Nick does a very good job.
He does. If you're outside the United States, the thresholds are $200,000 and $400,000 respectively. Lastly, there's the FBAR, which is from the Financial Crimes Enforcement Network. This is to prevent bad things from occurring. You have to file this form if you have an account that's more than $10,000 offshore if you're a U.S. resident.